In this video, we're going to talk about one of the most important and sometimes confusing concepts in this chapter, which is depreciation. At a high level, depreciation is how businesses recover the cost of assets over time. Instead of deducting the full cost all at once, we have to spread it out. Now, your slide breaks this into 4 key components, and this is a really helpful way to organize your thinking. First, you have your basis, which is usually just the cost of the asset. That is your starting point. So what did you pay for it? Second, you have the depreciation period, or the asset's class life. This determines how many years you'll spread the deduction over. Third is the depreciation convention, which tells us when in the year the asset is treated as placed in service. And fourth is the depreciation method, which determines how the cost is allocated over time. So when you're solving depreciation problems, you're really working through these 4 decisions. And just to connect this to the tax return, depreciation is reported on Schedule C, Schedule E, or Schedule F, depending on the type of activity. Now let's look at some common recovery periods. Now you don't need to memorize everything, but you should recognize the patterns. Short life assets, so things that wear out quickly, have shorter recovery periods. For example, 3 years for specialized tools, 5 years for things like autos, trucks, and computers, 7 years for furniture and equipment. Then we move into real estate, and we have 27.5 years for residential rental property and 39 years for non-residential property. So generally, personal property equals shorter lives, and real property have much longer lives. And that's a kind of a helpful way to think about it. Now let's talk about how we actually depreciate assets. There are 3 main methods shown here on your slide. The most common is the 200% declining balance method, which accelerates depreciation, meaning you take larger deductions earlier on. There's also the 150% declining balance method, which is a similar but a little bit less aggressive approach. And then there's the straight line approach, which spreads the deduction evenly over the life of the asset. But here's the key idea. Your accelerated methods give you a bigger deduction earlier, so a bigger deduction in those earlier years of the asset's life. Your straight line depreciation spreads it out evenly over the asset's life. Under makers, most assets actually start with an accelerated method and then switch to straight line later. Now this is where things get really interesting and honestly more practical. Bonus depreciation. Bonus depreciation allows taxpayers to immediately expense a large portion or even 100% of an asset's cost in the year it's placed in service. So it applies to assets with makers' lives under 20 years. It applies to new or used property, and in many cases, it's fully deductible. So here, instead of spreading deductions over time, taxpayers can take a huge deduction up front. Now, one thing to note about bonus depreciation is that these rules have changed over time, and the percentage can phase down depending on the year. But conceptually, just remember that bonus depreciation means you're going to have an immediate write-off rather than spreading it out over the life of the asset. Now, closely related to bonus depreciation is something called Section 179 expensing. This is another way to immediately deduct the cost of assets, but here's the key difference. Section 179 is elective, and it has limitations. So for 2025, taxpayers can expense up to a maximum amount. Your book has these thresholds. But more importantly, Section 179 is limited to business income. So unlike bonus depreciation, you can't use a 179 deduction to create a loss. If the business doesn't have enough income, the excess deduction is carried forward. So think of it this way. Bonus depreciation equals an automatic, there's no income limit. Section 179 is elective, but it is limited by income. So students often mix these up, so just make sure that as you're going through your homework that you have that distinction clear. Finally, let's briefly touch on leased vehicles. Instead of depreciation, when a taxpayer leases a vehicle, they generally deduct the lease payments. However, if the vehicle exceeds certain value thresholds, what we call luxury auto limits, the IRS requires an adjustment called lease inclusion income. This essentially adds a small amount back into income. And the idea here is to prevent taxpayers from avoiding depreciation limits by leasing instead of buying. But overall, the key takeaway is that lease payments are generally deductible with some adjustments for high value vehicles. So stepping back, depreciation is really about recovering the cost of assets. And there are multiple ways to do it. Again, we talked about our standard maker's depreciation, bonus depreciation, Section 179 expensing, and then the special rules for things like listed property is talked about in your chapter, and vehicles. As you work through these problems, focus on identifying the asset, determining its recovery period, and applying the correct method or special rule. If you can do that, you'll be in great shape. All right, that brings us to the end of this section. Reach out if you have questions.